Good morning, team. Welcome to Swing Trading Live. As always, going to be doing this every single, or at least the next month, to see if you guys enjoy this or not. But basically, it's me going through the market and dissecting what's going on to give you an advantage to understand trends, directions, top stocks, and everything you need to know to be profitable in the market. So quickly, as always, before you get started, just a quick understanding of what Swing Trading Live is, just so you have a better understanding. It's the only stream for swing traders who want to profit, learn about new strategies, and potential breakout stocks before anyone else. It's also my promise to you during a live stream is that you understand the current market direction, you get trade plans for great stocks, you learn something new, and hopefully you can communicate with other amazing traders in the chat box, or at least not you're chatting with me, so that's awesome and fun too. The schedule for today is typically a welcome, market analysis. We do today's top stocks. Then we check out the opening bell. What has changed since market open? What is our game plan for the rest of the day? Then we have a training segment, a how stupid is stupid segment, and then a live trading segment. So anyways, that is Swing Trading Live. We're going to jump right into it now with stock market analysis. So this is the S&P 500. We really had a very bad day on Tuesday. Again, if we zoom in more to a cold time frame, we'll understand what went on. You can see here, if you kind of look at this, Monday when we were dissecting the market, we understood that there was a trading range right here, and so this trading range was really what we were looking at. And so basically the game plan was, if you watch the live stream from yesterday, is that we were either going to stay in this range and be neutral, we're going to break above and be bullish, or if we broke below this, we knew that it was going to be a bearish day, and that's exactly what happened. We broke below this bottommost support, and we just kind of trended down for the rest of the day. Now the next thing we're looking at is maybe for a 10% continuation play strategy for a further move down. But what we're already seeing is that pre-market, the market is up. So if we want to understand pre-market better, we can go to the S&P 500 futures. And so again, that's going to help us more. The reason being is because the futures have trading action overnight. And so that overnight action will actually show us what happens. You can see here the market closed yesterday around this level, around the 39.88 level. And then throughout the night, we kind of went up, came down, went up, stayed about even, but we are a little up pre-market so far. So is this a good sign? This is not. Well, if we actually extend out those lines from Monday with this crucial support then becomes resistance. So again, it looks like this is our major zone. We have probably a volume shelf right here, which means that we have a lot of accumulation at this level. When we have accumulation in this level, the market's going to be drawn to it. So we can see here that the market keeps being drawn into this level over and over and over, which isn't necessarily a bad thing per se, but what it does mean is that we're probably going to hover in this level. It looks like the market wants to hold. We have these red days, but anyways, what I'm really saying here is that we have a chance to be neutral in the market, but if we break below the prior support level, then we're most likely going to be dropping lower. So again, you can see here we're kind of trending up, but if we break this level right here, 39.80 on the S&P futures, then again, it's just going to be another bearish day. And so again, if we're looking at another bearish day, we can kind of look at the stock that we were looking into yesterday, where we were kind of predicting this move up higher. So again, you can see here we're kind of looking for a break above this level here, which again we got, and then it went up. And so again, the inverse ETFs went up 2%, which isn't bad at all. But again, inverse ETFs, for those who don't know, go up as the market goes down. So again, this was a stock that we were looking at yesterday. So anyways, guys, understanding your options is always great when looking at this, because when you're looking at the market, there are so many different ways that you take advantage. Let's say you want to make money to the downside, well, you can use inverse ETFs instead of using options per se. So that's definitely one way to do it. Anyways, that's about it for my market coverage so far today. Again, if you have any stocks that you want broken down, feel free to put it in the chat. But what we're seeing here is that the market is trying to hold steady. We have a solid support at 396 on SPY. If that support breaks, then it's all downhill. If not, it's probably going to stay neutral. We won't really turn bullish per se until we get around or above the 406 level, which was a very strong level on Monday and Tuesday. So those are our levels for today. Again, we'll recap really what's going on in the market when the market opens. But outside of that, that's kind of what's happening here. So Moving on, let's put this up. Let's look at top stocks for today. So, if we quickly zoom into our top stocks, looks like we have three. So that'd be QID. So let's take a look at QID. So QID here, again, trends well. The only minor problem here that we have is volume is a little low. Sometimes you have 100, sometimes you have 1,000. Typically, when you're looking at this, you want your average volume for the day to be around 200,000. So if we want to take a look at that, we'll go to a daily candle and we'll look at the volume for that. So again, it looks like we're having around 9.2 million. So again, we are having a decent amount of activity. Not only that, if you don't clearly understand the movement of QID, that's completely fine because it's based off QQQ. QID is the inverse of the QQQs. QQQ again being the NASDAQ technology type index. So again, when we have that, we have the inverse. So of course it's up because the market dropped yesterday. So this is up. Here is a great example of being able to make money to the upside. So QID was a great stock. Again, it's a little down pre-market, but it's going to find support here around 21.22. Again, given the market does not break any major levels, then again, we can kind of expect another red day if we break below that 398 level that we're watching, which would make QID a great potential buy. So that's kind of what's going on there. Another stock we have is JKS. So JKS. JKS is again, it looks like a solar holdings company. Not my favorite with volume wise, and it's not an ETF, so there's nothing we can base its movement off of. And then CDEV. CDEV is again a great stock that kind of went against people. So again, what was great about this stock right here, again, volume is low. Which isn't the best setup if you're trading more than, let's say, 50 shares. But again, for the smaller accounts, that's completely fine. But again, what we saw here was this triangle breakout, which is where actually one of my coaching clients bought it on the triangle breakout. Then we had that reversal because the market just crashing. And then next thing we know, we gapped lower and now we've just been holding resistance. The good news is that it's holding this range right here. The bad news is it's holding a range. There's not really too much money to be made within a single range like this. When the range is this small, there is no point. When the range between two stocks is upwards of 20%, then you can easily trade within it. But this range is only 2%, 3%, so we can't really make much money in the middle of that. If we're looking at other stocks on the screener here, looks like we have Plug, Murphy. So let's take a look at those. Plug and Murphy. So PLUG, Plug. Again, if we're looking at Plug, what we're seeing here is that we're kind of trending down, trending up, trending down. It looks very neutral. Let's get a more comprehensive view by going out to the daily chart. You can see here Plug took off initially. This is actually a great stock for all those who took advantage back in 2018, 2019 slash 2020 more. I think it was loaded 2020. Yeah, it was alerted on 2020. 2020, I alerted Plug at around $4, and then it took off and it did like 1,000% return. $4, yeah, around a 1,700% return max, around that. And I actually alerted that on my Instagram page. If you don't follow me on Instagram, go there at The Impeccable Investor. The reason being is because so many people took advantage of that and were able to make money. So again, I post alerts there on occasion. Again, most of the alerts come through the Impeccable Stock software, which again, free trial linked below. But anyways, Plug, and we're looking at that. Plug again is hitting a resistance here at $31.39 with a support around $13, $14. So again, we're kind of trading in a range, and we're in the utmost portion of the range, which means we have one of two game plans. If I go to more of a 5-minute chart, is that we're waiting for a breakout above the $31.80 level or $32 level, or we're just going to wait for the market to drop all the way back down to its previous lows around $25.50 or even quite lower than that, being around $17, $14. So again, two different types of setups and game plans is one, waiting for the breakout, or two, waiting for the dip. Ultimately, those are the only two ways to buy in the market, is to buy a breakout or to buy the dip. The other stock we want to look at is MUR. So MUR here, again, is Murphy Oil. You can see here it's choppy, which means it goes up and down a lot, but it does hold its trend well. So that's always a good sign to find a stock that's trending well. You buy it on the lower end. But again, if we want to look at a more comprehensive view, we can see here is that we're just in this minor uptrend, probably hitting a top, wanting to come down to reset to around $32. Why is that? Well, because look, it just naturally an uptrend goes up, down, up, down, up, down. It had its previous uptrend, so now we're going to have to pull back. Where will we naturally pull back to? Any previous level that has or was resistance that now became support. So again, right here around 3107, right here around 32. So again, those are two examples where the market can pull back to. So that's kind of what that is. So those are the top stocks in market overview for today. I'll just stay on this page. Here is what our news for today is. We already had all major news. Specifically, we had a FOMC member speak already at 7 a.m. Central Standard Time, about an hour ago. We had ADP non-farm employment change. You can see here we saw a change of 132,000. So again, a difference that's probably going to hold down the market a bit. So what the market was expecting to see was an unemployment change of 300,000. What we actually got was an unemployment change of 128,000. So again, that's kind of what we're looking at. Chicago PMI is being reported in the U.S. markets at 9:45 EST, so that'd be 8:45 Central Standard. So in about 30 minutes, we'll see a Chicago PMI report. That may add a little bit of extra volatility, but not too much because it's only concerning one state instead of all the states or federal type of policies. Now, again, we have one or two couple major news reports coming out on Thursday, and then we have a lot of news reports coming out on Friday. Thankfully, those reports are coming out pre-market, but also Friday's just going to be an extra volatile day because we're going into an extended weekend. The extended weekend being Labor Day the market will be closed on Monday. So a lot of trading activity will happen on Friday to make up for the extended weekend. And then again, Tuesday will have an extra volatility as well because of the people who could not trade on Monday and just having a little FOMO and just being a little missing out. So that's kind of what our economic calendar outlays look like. That's kind of what we're expecting from that perspective. Anyways, that's about it. Looking from top markets. Again, we're going to go into a training segment. Then when we come back, we'll do the opening bell because, again, we defined our trade plans pre-market, and now we need to kind of see where the market opens and kind of track that opening to understand what's going on. So, again, while we have our free time, let's do a market segment, which I know a lot of people have been having questions on. So I'm so excited to put this training together on how to read stock charts. So again, if you're excited about how to read stock charts, stay tuned because here we go. Right after this, we will have the opening bell segment. So let me remove my face and get this. Welcome to the most important lesson, in my opinion, of this whole module, the stock market mastery section or the stock market basics section. We're going to do a complete overview of technical analysis and how to read stock charts. This is going to be one of the most important lessons to prepare you for the trend following mastery section of the course. Now, again, as always, let me repeat the quote: master the basics and practice them every day without fail. Small disciplines repeated with consistency every day lead to great achievements gained slowly over time. John Maxwell. This is a very important quote for this lesson. What I'm about to teach you how to read a stock chart and everything behind this is the basics. If you don't know this, you will struggle on everything else. So work on understanding this. Watch this video a few times if you need. And, if you still don't understand it, feel free to shoot me an email, or if you're a coaching client, then, of course, reach out to me and we'll discuss it on our one-on-one call. But this is what we're really going to get into. Technical analysis is one of the oldest professions and skills around because it works. Back in the day, people who traded in the pit would remember price points that the stock dipped at before and where it fell at, and then traded those levels. Charting is also very simple because you don't have to predict or guess how people will respond to certain financial reports or news. Instead, you react to what the market or the stock is actually doing. So the concepts that we will cover in today's video: stock chart, reading a chart, time frames and more; reading candles, discussing what the candle means in common patterns; volume, where to find it on the chart and why it's important, how to use it; support and resistance, learning how to chart out supply and demand; trend lines, mark trends on the chart to assess direction; and time frame analysis, using time frames to determine major and minor levels. So let's get into this. As in the last video, we discussed charting platforms, and what I will be using throughout this entire program is tradingview.com. Why? Because it's amazing and it's free. So let me use tradingview.com, and let's talk about the first one, is the stock chart. So this right here is a stock chart. Let me remove stuff, make it a little simple. So this is what a stock chart is. So very simply, a stock chart shows the historical price of that stock. Where has this stock been trading over the years? And so again, I'm going to break this video down very simply. So if this annoys you because you know some of this already, I'm sorry. The bottom line shows the time. This is the date every single day. It shows what is going on. This is, the time frame. You can see here, this is what the stock has been like. In 2013, it was around $141. Now it's at around $300, $400. So again, the bottom line shows time. The right axis right here shows the price, how much this stock is actually worth. So a chart is simply a visual representation of the price history of that stock. And that is amazing, because price history will show us things like certain levels that we can use to make money. Now again, this is what is known as a candlestick chart, because each one of these is a candle, but you can switch that. You may see bars, you may see that's just still candles, but you may see a line, you may see an area. These are all ways of representing the historical pattern of the stock. But the most beneficial one are going to be candles and or bars. Bars and candles do the same thing. I just think bars look nicer. But why are candles so important? Well, let me break that down here for you. This is going into the next section already. Let me just make sure, because I can jump. I have a tendency to jump, so make sure I cover all these. Let me cover time frames first, and then we'll go into that. So here is the time period over time. This is the price axis. So we talked about the different ways that that price can be shown. It can be shown through candles, lines, etc. But we can also have different time frames. So for instance, each one of these candles at the moment represents 1 day of trading activity, or 1 day of price activity. Now, the reason I know that is because it's set to 1 day. Whatever this is set to means that each candle or each moment will be set to that. So for instance, if I set it to 1 second, it's going to show me 1 second of trading history. That's going to be quite crazy, honestly. But I can go down to 1 hour. So for instance, now each candle represents 1 hour. And so again, you can kind of get, this is more of a choppy view because it shows more of what's going on, but you can really start to see other patterns as well when you start to mess with these charts. So again, you have the 1 minute chart. This is primarily used for day trading. You can see what actually happened within that period of the day. You can see here, this was 2022. So this was the Friday. It opened here, kind of had a little consolidation breakdown. But anyways, we'll be getting that into those type of concepts in the next module. But you can see here that the time frame that you set it to will show how much activity you see. So again, the larger the amount of activity within a certain candle, the larger of a time frame you can zoom out, right? Because it's just only so much a chart can hold. This chart can only hold about, let's see, it's the 23rd, so it can only hold about 8 days of 1 minute price action, versus if we change it to 1 day, where each is 1 day, we can see, up to 8 years. Is that right? That's about right. Close enough. About 8 years. So that's kind of what that shows. So that is time frame analysis. Now we're going to go into reading candles. So again, candles are very important. So let me break down what a candle is. So let's break down the green candle first. So you can see here, a green candle has a bottom little base to the whole body. So we have a body line of the body, we have a top line of the body, and then we have these lines that come out the side. So here's a great example. The lines that come out the side. These lines are called wicks, and this is called the body. So again, for a green candle, the bottom body is where the stock opened for that day. Now I say for the day because we're on a daily chart. If you're on a minute chart, it's going to be where it opened that minute. So on the daily chart, on this day right here, September 21st, what we're seeing here is that the stock, or this stock right here, opened at $436. And now again, the lower wick is the lowest price that stock reached that day. The upper wick is the highest price that stock reached that day. And then the close wick is where, the top of the body is where the stock closed for that day. So you can see here that SPY opened at around 436. throughout the whole day, went to a low of 433, made a high of 440, and then came back down and closed that day at 437. So this shows you a lot of trading history, and this is very, very important. We'll be getting more into certain different candlestick patterns that show in the next module, but knowing how to read a candlestick chart is important. So that's how it works for a green candle, but now it's the reverse of a red candle. Red candle means it closed lower, it's red. So that means that the top body is going to be where the stock opened that day, and the bottom is going to be where it closed because it closed further down, and so the wicks still apply, the highest it reached and the lowest it reached. The next thing we're going to cover is volume. So again, volume is quite important. So if you can see here, all these little lines on the bottom of a chart, you can see you can remove them by hiding or whatnot. But volume is crucial. Volume shows how many shares were traded that day. So you can see here when I hover over it, we can see here on this huge green candle day, if I highlight this, it's going to highlight this. And over here on the indicator side, it's going to show how many. So if I hover here, it says 99.6 million shares traded that day. Again, this is a very popular ETF, but 99.6 million shares. Why is that important? Why is volume important? Well, because the stock market is what is known as a zero-sum game, which means in order to buy shares, you have to have someone who is willing to sell shares to you. And so again, if the volume is typically low, like let's say only 10 shares are traded a day, it's going to be very hard to buy at the price you want to buy at. And it's going to be very hard to sell when you're ready to sell because there are going to be no buyers who are willing to buy. And so again, for volume, you want to see high liquidity. You want to see a lot of volume. Why? Because number one, it means you can easily get in and out of that stock, and number two, it means that price will be more accurate. When there are more buyers and sellers affecting a stock price, buying and selling, that means the price is closest to its true value. And so that's kind of how we look at that. So volume is important. In general, you want to be looking for stocks that have an average daily volume of 100,000, if not 200,000 and more, to be in a highly liquid stock. So that's kind of what you're looking at volume-wise. Again, volume will fluctuate and change based on what the market is doing. Volume will obviously pick up when people get scared, right? You can see here this drop and people are selling, right? And so all this selling action increases volume because people are selling more than they typically do. And typically, just to explain volume a bit more, we'll get into this later, but when volume is low, it means that the trend will continue. When volume picks up, that is a trend continuation because people are doing more things out of the ordinary. So you can see here how we have these huge changes right here because of this huge dip, and this kind of like, okay, a crazy action and reversal because of this huge volume still sticking. And then as we start trending up and the volume starts to dissipate and the direction continues, this is a healthy sign that the trend is continuing. Why? Because it takes less volume to push that stock up, which means that it's a healthy move to the upside. So that's another way to read volume. Okay, next we're going over support and resistance. So support and resistance is another crucial part of trading. Why? Because it helps us know what levels are important. So again, on the TradingView platform, you can click this light here. You can click a trend line, or you can click arrow, you can click ray, you can click horizontal line. Horizontal line is typically easy because I can just click one place and I'll make a straight line across the whole thing. If I use the trend line, then I'll have to click a start and end point. But anyways, so resistance points are going to be where the stock has topped out before. So if I look here, you can see the stock has gone up to here and tested it and then topped out. So I'm going to put a resistance line there. Let me make the resistance red. Okay, so now we have one resistance. We can see here, I'm just looking at resistance levels right now. We topped out right here, right? We went up, we topped, and we came down. So I'm going to put a resistance level here. Oh, I didn't click this again. Here. So that's that. Let's do two more. So I'm looking on my way down, right? It topped out right here. So let's add one more right here because it topped out. And let's add one more. We'll add this one right here. You can see how it went up to the top and then got topped out and then came back down. So here are our marks of resistance levels. Now, something I do have to tell you, because this is very important right here, is resistance and support can be each other, can be the same thing. So let me explain that here in a second. Now let me do support levels. Support levels where a stock comes down, hits a low, and then reverses. So for instance, here's a great example. It came down, it formed a low, and then it bounced higher. So this would be a great example of a support level. Let me make this green. So support level, let's chart out another support level to prove my point. So let's say, look, the market came down to this level and bounced. So this must be a support level. Oh wait, this is a support and resistance level. How can that work? Okay, so just to recap one more time. Support is where a stock has fallen to before and bounced. Resistance is where it has hit a top at and bounced. Now, Support and resistance can alternate. And what I mean by that is a resistance becomes new support, and a support level that's broken becomes new resistance. And so what does that mean? It means that if a stock is going higher and it hits a top, and that becomes a resistance level, and that resistance level in the future can become a support level, right? If it had a hard time breaking above this level and then it finally broke above it, then this will be a strong level and people will know it. So you can see here we come back down and then we end up bouncing at this level because it was a strong resistance level before. So resistance and support play into each other and can help like that. Here's another great example. This line right here was a resistance point, right? We had a hard time breaking above it. Then we did. Then we came back down and we used this previous resistance as a support level. So we supported here and bounced. We kind of had some consolidation here. Then we broke through. And now this previous support level that got broken became a resistance level. It came up here, got rejected at this level, and came back down. So support and resistance levels are important. At the max, you only need, when you're looking at a stock chart, about 3 levels on your chart. So again, let me remove all these and let's go into the 3 basic levels. Why? Okay, because one, if we start adding so many lines to our chart, it's going to get complicated and we're not going to know what to do. So let's just break it down in 3 simple lines. I like to go on the daily chart, and from there I chart out my highest line. I chart out from here the most recent support. So again, this is probably like the lowest one that's going to affect me in this trading range. And then I like to put in a couple in the middle. So let's say about 4 lines total, right? I like to know it's the middle line. So you can see here, I have 4 lines, boom, done. That is how I know for this daily chart. These are going to be levels that the stock will be drawn to. You can see here we're further from this level. So right now we're trending up, so it's going to be drawn to this level. If we were trending down, it would be drawn to this level. Once we break above this support, then we're going to be drawn to this level. So very simply, 4 chart lines that I can look at. Now, the next thing I want to discuss is, I believe, trend lines. Yeah, so trend lines. Let's go back here. So trend lines, we're going to change it to default trend lines right here. And so trend lines show the direction. And how we draw trend lines is we connect lows and we connect highs. So you can see here, if I connect all these lows, see, a low is a low right here, low right here, low right here, low right here. If I connect these lows, this shows a trend line. This shows that the trend is headed to the downside right now. The trend will show where a stock is heading. You can also do this by connecting the highs. So you can connect highs, but again, I'm kind of like, I know I'm breaking above this, but most of the highs are connecting here. And so again, on the bottom portion, you can see here I can connect most of the lows, just like this, connect most of the highs, like that. So we can see trend. A trend shows us where it is going. Now again, we don't really need to chart these all the time, especially on the daily, because we can look with our eyes and understand this is heading higher, and we can look with our eyes and understand this is heading lower. But again, trend lines are just a great way to visualize the direction of the stock. The way that the market is structured, if you reviewed in module 1, where I gave you recommended books, and the book I gave you was the technical analysis of the financial markets. Again, it's a really old book, but I'm sure you can find a PDF of it online for free. It describes that the market has a trending phase, a consolidation phase, a downtrend phase, another consolidation phase, and then a break higher. So you can see here we have a trending phase up, then we have kind of a neutral phase where it stays kind of flat, and then we break through that phase and we go down to downtrend. So anyways, the market is full of cycles. It goes up, it's flat. It goes down, it's flat. It goes up, it's flat. And this is what is known as the stair-step pattern, where over time, the market will use these support levels and kind of like go like this, and known as the stair-step pattern, and it will slowly over time just keep going up. So that's kind of what the market does and how that works. So let's get out of that. Remove all these. And that's basically how that works. Now, again, I'm just setting the basic frameworks on how to read a stock chart. So don't, like, if it doesn't make sense, rewatch the video. If not, please feel free to reach out. But again, in trend following mastery, we'll get into more of the specifics. So that is trend following. Now we're going to use time frame analysis. So again, when we look at major support levels, remember I said we're going to try to have about 3 to 4 support lines and resistance lines on the daily chart, and that shows us what is known as our major levels. After what is known as a major level, then we can zoom down into, let's say, the hourly chart to find the minor levels that will be impacting our day. So again, we can see here, and it's the same process, right? Okay, this is the minor level. Oh, I I need to click on it. This is another minor level. So now we know the minor levels. And again, I would make them a different color. For me, I make my major levels on the daily chart like white, and then I make my intraday ones on on a shorter time frame, I make them yellow. So that's kind of how that works for me. Anyways, time frame analysis is important because it helps give you an understanding of where the market is and trending as a whole, and where it is trending specifically for that day or for that week. So again, it just helps give you an understanding on different time frames to understand what's the major trend and what's the minor trend impacting. So the major trend will have an overall directional bias. So the overall trend for the overall market on a daily chart is bullish. Then you definitely don't want to fight that. But on the weekly time frame, it could have a little bearish trend. But what you do know is that bearish trend will probably reverse, because on the daily time frame, on the max time frame, we have a bullish direction. So that's kind of how time frame analysis works. That is the basics of reading stock charts. It's one of the most important videos in this module, and so I highly recommend you watch it again if it didn't quite make sense. Thank you so much for watching the stock market basics module. I hope it helped. I will see you in the next module, Trend Following Mastery. Welcome to the most important. And the opening bell is here. I hope you enjoyed that video segment on how to read a stock chart, getting into trend specifics, charting, all that stuff. Very helpful information that I know a lot of you could use and need. So anyways, I thought I'd share that. Anyways, we're getting into the market open. You can see here that SPY has gapped up, but it's trying to come down. As always, if you don't know this, statistically speaking, 9 times out of 10, the gaps like to fill. So what I mean by that is based on the gap, we like to fill the gap. And the gap is where the market closed the previous day versus where it opened the next day. Gaps like to fill. That is no real clear indication that we are bullish or bearish, regardless of how it gaps. It just means that, hey, a gap likes to fill before it can happen. So that's kind of what we have here. You can see a great example was from Monday when we had this gap down and we came up and we filled this gap and then we continued back down. It does not mean we're bullish just because we're coming up. It just means we're trying to fill that gap. And so again, that's an example of a gap fill. 9 times out of 10, statistically speaking, you'll see the gap fill on those markets. I don't know why my screen hates me and likes changing. But anyways, you can see that on the S&P 500 is that we're trying to come down here to this level to around 398.54. So that's something you can be expecting, is to see the market come down to that level before we actually pick our real trend. For those who don't know, the trend is actually identified in the market when we within the first 15 minutes. After the first 15 minutes, you can typically identify the trend for the rest of the day. So again, what you do is you chart out the 15-minute range for the first 15-minute trading action. After that, what you do is you look at, is it at the end of the 15 minutes, is it toward the upper portion of that range? You typically more times than not have a bullish day. Is it in the middle of that range? You typically have a neutral day. Is it at the bottom of that range? You typically have a bearish or red day. And so again, that's an example of how to use like a 15-minute analysis to get an understanding of the market for the overall day. Again, not 100% accurate, but it is a good way to get an understanding of the market. Watch the first 15 minutes of trading activity. Is it trading in the upper portion? Bullish? Is it trading in the middle? Neutral? Is it trading near the low? That's going to be a bearish day overall. So again, that's a good way to predict what the direction for the day will be by looking at the first 15 minutes of trading action. So that's, again, a very helpful tip that I've been using for a while as well. So again, if you didn't know that, congrats. You made it on the live stream. You got to learn it. Anyways, that's about it for the market for so far for SPY. It's really just trying to fill this gap. You can see this gap is now filling. It's coming down. So again, this gap fill to around 398.50. Once it hits this gap, I'm expecting a small bounce, and then hopefully we'll recover from there. Let's look at other markets. QQQ also doing the same thing. Again, let's remove drawings. So again, we're seeing the same thing here, right? We're trying to fill this gap. Again, QQQ just did it on a more extended way, as in like the gap up was higher, so the gap low needs to come down a bit lower. But again, the QQQ market is always moving faster than the S&P 500 because it's mainly filled with tech stocks, which are more volatile. So again, we can see that movement happen a lot more often. So that's kind of what we're seeing from that perspective. Let's see. Let's look at what I wanted to look at is DXY, something I haven't looked at in a while, and I was curious to see how it's been performing. For those who don't know, in current recent news, the euro and the USD are currently have a 1-to-1, a roughly 1-to-1 exchange rate. Typically not the best, right? You want to see the US dollar being stronger than other currencies since it's the world reserve currency. So again, with that is actually a very weak sign for the dollar overall. So again, I just wanted to take a look at the dollar on a daily time frame. So this is actually quite interesting to see this run up here recently. So typically what you see in the dollar index is a progressive downtrend, just because the dollar is progressively getting weaker. So you can see here the dollar looks like it's getting stronger, which is quite interesting, especially here in this period of 2020. It makes sense this little return because I believe like 50% of the money in the world right now has been printed in the last like year or two. So that's quite crazy, and it's probably why we're seeing a lot of inflation. Anyways, with the increase in the dollar index, this is going to have an inverse relationship on a lot of the stocks. So again, that's what we typically see an inverse relationship between those. But again, it's not always that. That's just typical. But anyway, so we have the overall market, the dollar index, and QQQ. Now, again, those are the main indexes that we look at to understand market direction. Again, if you want to look at a specific stock, feel free to put it in the chat, and I'll definitely see that, and then we can break down those stocks. But typically, that's what we have for the overall market to watch. Let's take a look at SPY. It should have filled that gap by now, and then now it should be hopefully pushing higher is what we want. So, but again, if not, it's going to break that 398 low. So if we come here, yeah, you can see here that we're now bouncing, right? We hit that low. Now we're trying to bounce higher. And again, we'll just have to see here. Again, we're only 6 minutes into the market. So again, we have a lot of trading day left. And again, we won't really know anything more until we hit 15 minutes of market activity. And again, we'll show a great example of that. So again, that's kind of what we're looking at for the overall market. Again, this is our volume range we expect to be in. If we break below this level here of 395, it's going to be a very strong support level. And if that gets broken, we'll probably have another red day. Anyways, nothing too much more to say on that. It looks like we're trying to have a rebound here on the overall market. So that's kind of what we're having from that level. This is a great market. So for those who don't know, I should go on a tangent here. Is that covered calls are a great way to make money. So for instance, for those who are using a long-term investing type of approach or a long-term swing trading approach, where you're expecting to hold a stock for a couple of weeks to a month, a great alternative strategy to that is using covered calls. So if you don't know, a covered call is an approach where you sell a call on shares you own. So for instance, if you own 100 shares of a stock, you can sell a covered call against those shares, thus collecting premium. And why is this an amazing strategy in this market? Well, because the way this works is, let's say you have a long-term investing portfolio in the S&P 500. So being this, for example. Well, you can see here, we've been trending down recently. So what you could have done is every single week, go out and buy, let's say 0.16 delta, or sell those calls. And so again, basically what you're doing, let's say the market is trading here and you're selling calls right here. So basically what this means is that you only have to sell your shares, aka execute the call option, if the stock gets above this level by the certain date that you selected. If it doesn't, which is in the type of market we're very neutral and bearish, then the market's going to trend down. So if you're already holding the stock for long term, guess what? By the time the week is over, the stock is lower than your strike price, which is going to allow you to keep all the premium that you made. So, for instance, if you sold $1.50 call option, that means you keep the whole $1.50 in your bank account without having to do anything. And $1.50 in option world is $150, which means that over this period, even though your stocks lost money, it would have initially because it's a long-term portfolio, you now collected $1.50 in premium, which helps offset losses as well as increase income. So again, covered calls is an amazing strategy to implement to help you decrease your losses, especially on a long-term portfolio. Statistics have proved that it's actually the best way to beat the market. And what I mean by that is for people who are saying, oh yeah, I'm doing the bare minimum, actually the bare minimum should be doing covered calls on your position at a delta that you hardly ever will get executed on. And that's actually one of the best ways because it increases your return from about the normal 8% return a year to roughly 9 to 10% return a year. And again, an extra 1 to 2% every single year compounds on itself and it can return a massive amount. So again, covered calls are a great approach for a long-term investing strategy. So again, I would highly recommend that. Anyways, that's just a covered call little rant. But if we're moving on here, we can kind of see the charting levels here and the market starting to bounce. This is a great example. Again, we haven't even hit the first 15-minute mark of the day. So again, we can't really say much. But what I do want to say is that this is an example of just because there was a gap does not mean that's going to predict direction. So like I said, nine times out of 10 gaps fill. So this gap came down to fill and it filled. Now, just because it was going down does not mean that we're going to have a bearish day. I mean, we could, but it does not mean that we're gapping, we're coming down because it's bearish. It just means that the gap is filling. After the gap filled, then we get to see the real direction and we get to see where the market actually wants to go. $3 minutes until the first 15 minutes of the day, and then we'll have an understanding of where the rest of the market will go for the day. And then I think we'll conclude our live stream after that, after we get a good understanding of the direction for the day. All right, so I wanted to explain this a bit better for those who don't know. This is called the 15-minute approach, 15-minute idea. This gives you an understanding of how the market will perform for the rest of the day. So what you do is you look at the first 15 minutes of trading action, and this helps you determine in the first 15 minutes how the rest of the day will be. Will we be bearish? Will we be bullish? Will we be neutral? And so again, I wanted to give you some examples of this, and then also for today. So anyways, what we see here is we look at the first 15 minutes of trading activity. You typically do this on a major market index like the S&P 500, although it can work on individual stocks too. So for instance, what we do is we look at the first 15 minutes of trading activity. So what we do here is you can see the first 15 minutes for this day starts here at 8:30. So again, we have an upper range here. That's not even close to a straight line. we have a lower range of first 15 minutes ends about right here. So we have a lower range of here. So how this works is the first 15 minutes closed right here. And so again, what the 15-minute range states is that we look at our 15-minute range. Is it in the middle? If it's in the middle of this range, then the market for the day or the stock or whatever for that day is expected to be neutral, which means very range bound, up and down. Now, if it closes towards the upper portion of this range, then we're looking for a very bullish day. If it closes towards the bottom portion of this range, we're looking at a very red day. And so again, here's a great example. We closed to the bottom portion of this range, predicting a red day for the day, and then we had a nice red day. And again, I want to look at other examples as well. So again, we have this day right here where the market opened. We get to the first 15 minutes to show you that sometimes it works and sometimes it doesn't, but it's a good way to help you understand the overall market. So again, you can see here we have a 15-minute low right here. And then we have our 15-minute high, 45, right here. So again, we hit a high of here. And the first 15 minutes, we were right here. So we were close to the middle of the range. Again, an upper range means that we're pushing up against the upper top portion of that line. Lower means we're pushing on the lower. This one is roughly neutral, which means we're going to have a very range-bound day. And you can see here that we ended up having a very range-bound day where it did nothing. Now, again, let's look at the next example for today. You can see here that we opened the day here. So this was our 15-minute high. You can see the next at the end of the 15 minutes was roughly right here. So we had a low of right here. You can see after the first 15 minutes, the market closed towards the bottom portion of this range, predicting a bearish day. And then what do we have? We had a very red and bearish day. So again, this is the 15-minute breakdown. Again, since we just hit the first 15 minutes of the trading today, I kind of wanted to break that down as well. So again, the market had a high in the first 15. Is this the first 15 minutes? Yeah. Then the first 15 minutes of here. We had a low of the 15 minutes of here, so quite a large range. And now the first 15 minutes ended right here, so it ended about here. This is neutral to bullish day. So this is predicting that we're going to have a very neutral to bullish day. And so again, this is a great way to understand where's the market going and have an understanding bias of where it should go. Now, again, this is not 100% accurate. Do not trade a 100% based off this. But this is a good way to get in the mindset of, okay, look, based on the first 15 minutes, it appears we're having a very bullish day. And so, again, this one looks like a very neutral to bullish day. And this just helps give me a better understanding of the market as I go into the rest of the trading day. And so that's a great example. Anyways, if you want to learn more about that, I go live every single morning at 8 a.m. Central Standard Time to break down the market and top stocks. You can learn more about that there. And thank you guys for those who are live right now. But that's kind of what the 15-minute analysis is. So anyways, I'm going to be tuning out of the live stream here soon because we don't really have too much more to cover now that we know the overall direction. It looks like we're trying to push bullish. But again, if you want my personal watch list of stocks that I've traded or that I trade almost every single week, every single month that have outperformed the market, click the first link below and you can get my free watch list. Or if you struggle finding stocks, I'm going to give you my free screeners and filters and everything in the second link below. So check those out before too long. You can see here that we're having a very bullish day after breaking this 15-minute high resistance, which is a strong resistance. You can catch that breakout to the upside. Anyways, guys, thank you for watching the live stream. I will see you tomorrow at 8 a.m.